I wanted to run through the gaming and professional services sector and provide a brief preview heading into the FY19 reporting season. So kicking off, just got a list of all the coverage that we have here and reporting dates. As you'll see on the table, the majority of stocks are trading roughly in line with price targets. So there's not a lot of compelling value out there at the moment. But what I want to run through is kind of 4 key ideas that I think the network will be and clients will be keen to hear about. So one of them is IPH. Obviously, this stock's had a really good run of late and been very well supported by the market. Everyone's excited about the XIP acquisition. It is a defensive business. Patent filings have grown at an average of about 2% per annum over the last 23 years. Filings, however, do fluctuate from period to period based on client requirements and so forth. But overall, they do trend higher, as I said. And what we see in this table here is just I guess the market shares of all the listed companies as well as IPH's market share over time. And there has been a slight decline over the years for the filing businesses, but we just view that as natural attrition as they move away from operating with listed companies. Post the merger with XIP, IPH will hold about a 40% share of market. One of the key drivers for filings is global R&D spend. And the chart here shows a couple of the key countries. Globally, it's averaged just over 2% since about 1996 as a percentage of GDP, but it's ramped up in recent years as the chart shows. Interestingly, it's expected to grow by about 3.6% in 2019, with China one of the countries that have been ramping up spending considerably. That said, they still only invest about 2% of GDP on R&D, while the USA is about 2.7%, Germany at 2.9%, and Japan at 3.4%. So certainly it can see much further growth coming from China. Talking about the stock specifics, the XIP integration is expected to occur on the 15th of August. Post this, the company will have leverage at around 0.5 times EBITDA. So there's certainly still scope for further accretions for this business going forward. We certainly don't expect any in Australia, given the market share that the combined group will have. But Asia and other potential secondary markets would bode well for investors. As I said, the stock has been well supported by the market and rallied quite hard and is sitting just below our price target. We do like the business on a longer term basis. It's got great cash flow. Expect potential upside to our numbers in the form of increased synergies, a better performance out of XIP, and obviously the strong currency tailwinds that they're having at the moment. Moving on to another stock that's been quite a bit of interest for investors, Jumbo Interactive. This stock's more than doubled since the first half 18 result. It's a couple of factors here that have caused it. There've been good customer growth, which has been driven on the back of the very strong jackpot performance. And put a couple of charts there. You can see that I've highlighted the first half and second half 19 numbers. And we have had record levels of jackpots as well as record average jackpot levels as well. So they're up considerably on previous periods. And that's a key driver of TTV for this business. That said, the first half, Tabcorp did call out about $45 million of revenue from favourable jackpots, and I think it'll be even higher in the second half. So at some point, this jackpot activity has to normalise, which will see obviously lower jackpots, lower average jackpots, and potentially lower TTV. So Jumbo does have the benefit, however, of benefiting from the continued push to digital, and we expect that to continue at probably 2 to 3 percentage points per annum. So that should see roughly 10% revenue growth for them for the foreseeable future. FY20 has started well. We've already had over $100 million Powerball. Oz Lotto's jackpotted again and is up to $40 million for next week. So it has been a good start for them. One thing we are watching is the sales numbers for tickets, and there has been some jackpot fatigue setting in. And jackpot fatigues where customers that would normally buy a $15 million ticket might hold off and then look to buy a $25 or $30 million ticket and play the higher jackpots, which will obviously result in the lower jackpot levels seeing less sales and impacting TTV. Jumbo will benefit from this for FY20 for the Set for Life product, which is being released shortly. This product is well suited to younger demographic and should certainly suit Jumbo's client base, given they do have that younger player compared to the broader World Lottery category. One of the reasons for the stock's performance as well has been the Powered by Jumbo SaaS product offering that they've just rolled out with the Mater in Brisbane. This product allows charity operators to effectively run their lottery online, provides all the systems, and Jumbo takes a percentage of the revenue or TTV margin for that. There's huge scope. There's about a $3.5 billion market that Jumbo are looking at, which includes Australia, Canada, and the UK, and they're targeting about 20% of this market. To date, the Mater contract's about $50 million per annum in TTV, so it's a good start, but the market's got very excited and has started to capitalise some of this growth, I think. The stock is trading at our price target at the moment, and 35 times FY20 PE, so it's certainly not cheap, and as I said, expectations are high, so they certainly will need to deliver a very strong result. We sit slightly ahead of the company guidance on this front, and we do expect further special dividends given the strong cash flow generative nature of this business and good operating leverage as well. Another one, moving into slightly larger companies, obviously Tabcorp. It's got an attractive dividend yield of about 5% fully franked. We do like the lottery business. As I said, with Jumbo, it has had will report a very strong result from this division. The issue we have is that for Tabcorp in particular, it's going to be a very difficult period to comp, given they only have about 23 to probably 25% of their sales being digital. So with such a large percentage offline, they won't get that natural benefit that Jumbo do from the shift to digital. Wagering's where we have a few concerns. It certainly is a very tough area for the company to operate in. Its customers have scaled, its competitors rather have scaled up through acquisitions, and the point of consumption tax doesn't seem to be causing them any issues at this stage. Tabcorp will benefit from revenue and cost synergies from the UBET acquisition, but we believe that they will continue to reinvest in generosities, which will impact the yields for the business going forward. Also, Tabcorp's in dispute with Racing Queensland at the moment regarding the calculation of the point of consumption tax. There's plenty to play out on this front with both parties at loggerheads as to how the calculation should work. But for the 3 months to December 2018, Racing Queensland alleges that Tabcorp have underpaid them about $11 million. So annualised, that's about $40 million. And it will fluctuate based on racing bets and so forth. But it's a pretty big number for the business. And given the contract runs to 2044, it could have material implications for the business. The stock is trading on 20 times FY20 based on our forecasts. We're not forecasting significant EPS growth as well, so I think people are viewing it as a defensive play in the current market. But given these headwinds, we retain a hold rating on it as well. And then lastly, People Infrastructure. It's been a great performer, particularly since they did the capital raising at 270 recently. The business has certainly diversified its product offerings since the IPO, significantly scaling up its investment and its weighting towards the NDIS and health space, but also the IT services sector as well. We do expect the company to make further EPS accretive acquisitions over time once the recent acquisitions have been bedded down during this half. Interestingly, there have been a few acquisitions of other IT services businesses by larger competitors around the globe and also domestically here, and they've been at multiples well above what PPE have been able to acquire businesses at, and also above where PPE is currently trading as well. So business is certainly well positioned heading into FY20 and beyond. It's trading on sub 14 times PE and offering double-digit EPS growth. So we certainly think that this one is a stock that you should hang on to for a while and expect it to be trading higher over time.